Hello, happy Monday and welcome back. Today is Monday, so it's the day where I break down some of the key things from the market headlines last week so that you can be armed with the knowledge of what you know for this week and looking at your investments. Hi, welcome back. If you're new around here, my name's Zoe and this is my channel Words on Wealth, where I, as a former wealth manager, break down some of the key headlines and investing terms to make everything when it comes to finance, jargon, investing, economics, markets, just that little bit simpler. I post on a Monday and a Friday, so do make sure you're liking and subscribing if you want to be updated with them. And of course, let me know in comments if there is anything useful that I could break down for you in the coming videos as well. So let's kick off with the first of three things that you need to know from last week's markets. First up, most major stock markets ended on all-time highs and really in the green, following the announcement of a temporary truce between the US and Iran, which led to some real highs and some positivity amongst markets and investors. It wasn't just the US markets that benefited in such a positive way. European markets, including the German market, the UK market, the Italian market, the French market, you get the picture. All of them finished the week relatively positive. This wasn't just because of the truce though, it was also bolstered by some strong earnings reports from banks in the US. In fact, there were many major earnings reports released last week. That's when companies tell us how well they've done in the last quarter and what they think the next quarter is going to bring. And usually this flurry of earnings reports that happens in the next kind of last week, this week and the following week really does give a bit of a bellwether point of view for what most investors expect there for other sectors and the overall markets to do as well. And major banks reporting in the US seem pretty positive, particularly on the consumer spending front. So what they're saying is that consumers are still spending, which has been a bit of a worry with all the talk around, of course, the conflict, the changing face of the economies, the potential tariff impact as well, having on inflation and spending. But actually, it seems like consumers are still spending, and this is generally a good sign for both the economy, because it means that money's still circulating and people are still happy and spending, and it's also good news for stock markets and particularly certain sectors who benefit from consumers continuing to spend and feeling relatively positive. And as we're on a positive roll as well, the UK economy also grew more in February than was expected. Whilst it was noted that this growth was prior to the conflict all kicking off and therefore the potential impact of that on consumer spending and inflation, is still all pretty good news. And this good news shouldn't be taken too lightly. I'm making a joke of it, but you get the idea. What this means for you and your investments is that if you're looking at your portfolio after this week, then things should look pretty rosy, because actually what we've seen is that most major markets have ended in the green, and we've seen that they're all looking pretty strong from both a base level economic basis, but also now from various different earnings reports of companies that are seemingly relatively optimistic about what is to come. Now, of course, a lot of that is hinging on this truce and the potential slowing or even stopping of conflict and fighting in the Middle East and the knock-on impacts that that could have on the wider stock market and the economy. So when we're looking at what's to come this week and what else it could mean for your investments, it's the classic hold tight. It's a truce. We don't know when, if that fighting is going to restart. If it does, that could well have the opposite, basically more negative impact once again on investments. I think it's fair to say that we're not quite out of the murky waters yet. There is not yet quite enough positivity to cling on to forever, so hold tight for potential changes. We're still very much in volatility. But the more you can prepare for that and the more you can prepare for things actually, potentially changing and seeing a bit of an up and a down, then the easier it gets. And for those that haven't invested yet that are thinking, is maybe now the best time? The answer to that is the same as always. Some would argue that now is a good time, we're in the positive, great news. Whilst others would go, hang on, it's almost the worst time. Markets could be at their all-time high. You could invest right now and see things just come down from here. Because really, investing at the worst times is often the best. Crucially, the key takeaway for anybody that's not invested off the back of this news is there is no such thing as the perfect time. Time in the market is much more important than timing the market. Bringing me on to our next story and the main headline that you need to know from last week, which is all about Allbirds, which is actually a sustainable wool shoe company, trainers, sneakers, whatever you want to call them, wherever you are in the world. Allbirds made waves quite a few years ago because they were sustainable and pretty cool, and they ended up with a massive valuation. $4 billion to be precise. However, they've not quite kept up with the size of this valuation and what that meant. Now their valuation has plummeted to 39 million, which is quite a drop-off. What they've actually announced last week is that they are pivoting entirely. This could sound like a good idea. Maybe they're thinking of diversifying into other areas of fashion. Perhaps they're going more sustainable. No, they're going to AI. This announcement caused its share price to go up by 582% in one day, which is absolutely... The company said it had struck a deal and was now changing its name entirely and would become AI infrastructure based. Whilst the share price is still at least 90% down from its all-time highs, it is certainly a bit of a jump and a potential revival. But what does this say about AI, firstly, secondly, the future of companies like Allbirds that are struggling, and thirdly, the world that we're living in? Well, first and foremost, for me, what it says about AI is that there is real hype there. To me, it is just mad that we can see a company climb 580% in one day after announcing that they're pivoting from being a sustainable shoe company to an AI company. Secondly, what it really tells me is that we are living in a world where companies can pivot pretty quickly, and that's kind of exciting, right? It means that potentially shareholders won't lose their money, it means that potentially the company won't go bust, and all of that is pretty positive from an investor perspective. But equally, is that what investors thought they were investing in? If you were a shareholder of Allbirds, you thought you bought a sustainable shoe company, and now you own AI. And that throws up all sorts of questions, not least of which from you might have built your portfolio around that company being part of your, let's say, fashion sector, and now suddenly it's part of the tech and AI sector. But equally, you might have put it in there as a sustainable move, and now you might have to pivot away from that. It really does highlight, therefore, the ever-changing world, third and foremost, that we're living in, and how keeping on top of your portfolio as an investor is really important. Because whilst I talk a lot about building a core with the likes of ETFs, I do know that investors like to throw in shares like Allbirds, which is sustainable and may well be a company that they back and support for that reason. But this pivot may well mean that actually it's not looking quite as you anticipated, and therefore maintaining views on those investments and, pivoting away when needed is really, really key. And last but not least, this is one that is going to hit both our pockets and potentially our investment portfolios, because chocolate is taking a hit. Over the last year, chocolate bars, the ones that you and I are buying and definitely not eating on considerable large levels, has got more expensive, which we might have noticed, only a little bit of course. Chocolate got more expensive because cocoa beans, the raw material behind chocolate, also skyrocketed in price. There was all sorts of reasons for this, but one of the main reasons was a poor harvest in cocoa beans. And that meant that supply was reduced. And when we look back at the basic laws of supply and demand within economics, when supply is reduced, generally we see the price go up. This is exactly what happened. Combine with this a mix of various different geopolitical tensions, some tariffs in the mix, some supply chain issues, and various different chocolate makers who are listed on the stock market are now really seeing the effects. Cocoa bean prices are set a year in advance. They are something that is relatively forecasted, but this can have both harmful effects on the farmers that are selling cocoa beans, as well as the companies that are then buying those cocoa beans, creating them into lovely chocolate bars and selling them on to the consumer. Belgian chocolate maker Barry Callebaut has reported that they will be seeing losses in the coming half a year, next quarter, but potentially reviving things by the end of the year. One of the main reasons for this is because chocolate prices did go up. But now what we're seeing is that with a good harvest, cocoa bean prices have actually come down, and we're seeing the opposite problem, whereby farmers are struggling to sell their beans, there is a surplus, they're not making enough money, and actually the companies also are struggling with profitability in the current moment from their chocolate bars. Because chocolate bars are more expensive, we're all buying them less as well. And you can see how this becomes a cycle and has a knock-on impact. Not least of which, if we throw in the mix things like weight loss drugs, which have become hugely popular, if we look at the estimates of people that are on them across the US, the UK and other European nations, you have to question if this is having some sort of knock-on impact to the likes of chocolate purchasing and other goods that are in a similar category. So what does this chocolate tail mean then for you and your investments? Well, firstly, if you've got particular exposure to certain consumer goods like chocolate and other sweet treats, you may well see a bit of a tough time and a dip. They can be notoriously volatile, but not always, and this could well be a bit of a change from what has been seen previously. Secondly, if you've got broader and more complex baskets of commodities within your portfolio, you might also see the knock-on impact of the likes of cocoa bean values changing. But it goes beyond this as well, because whilst we're talking about the cocoa bean harvest there, we're also talking about supply chain issues and the cost that has pushed onto the likes of the food that you and I buy and can eat. And this generally does have a knock-on impact on things like consumer goods companies, like Barry Callebaut that I mentioned there, the Belgian chocolate maker. And for our pockets, as I mentioned, chocolate may well be getting a little bit cheaper, as we have seen cocoa bean prices come down. However, spare a thought for those farmers that are struggling to sell their beans at the price that they were previously able to, and indeed continue to make a profit off the back of them. There is always swings and roundabouts when it comes to investing, profits, and what it means for you, I, and others around the world. So there you have it, 3 of the most major stories you can take away from last week's markets into this week's investments, and hopefully what it means in a digestible format for you and your finances. Do make sure you like and subscribe if you are enjoying these videos, and I hope to see you soon. Bye for now.